Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com points out the markets have gone from their worst month of the year to their best week of the year. He'll tell us why. Hilliard Macbeth, author of the second edition of When the Bubble Burst Surviving the Canadian Real Estate Crash, points to the weak points in the Canadian real estate market. He doesn't believe lower interest rates can save a crashing market. WolfStreet.com publisher Wolf Richter talks about the U.S.-China trade war. He says there's no sign of a U.S. recession, and he'll tell us why he feels that way. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Good to be back. You take a week off and things get volatile again.
Ross, taking a look at the equity markets, a dismal start to the week, and then all of a sudden everything's shiny and new and booming. What's going on?
Here, we looked back a week ago. The AAII, the Association of Independent Advisors, had the sentiment numbers down at 22% bulls. Now, anything under 20 is just unbelievably bullish. Anything under 30 is really constructive. So that's where it sat a week and a half ago. Then over the weekend, Trump makes the announcement regarding the tariffs and Mexico. And so Monday morning, you've got that big sell-off. And by the end of the week, you've got an outside reversal. You got a lower week with a lower low, followed by a close above the previous week, and a big volume, I think best week of the year. It's a market that's just stuck in a big trading range where you can go from one end to the other in just in a span of a couple of weeks. So, and with all of this, there was the flight to quality continued as far as the bond market was concerned. It rallied strongly all week, and gold, which had been flirting around the low 1300s, got a bid, and it ends up at 1345 at the end of the week. So a lot of big action here. So, for us, it becomes a matter of looking at opportunities. When we take a look at where things have turned from, the dollar index had been right at the top end, like 10 days ago, been right at the top end of its channel, going back maybe 6 to 12 months, up at 98 on the index, broke through the middle of the trading range during the middle of the week around 97.5, and that really became a spark for the gold market on the upside. And by the end, we're down at 96 and change as far as the dollar index is concerned, and that's keeping a bid on the gold market. So, and not only is gold doing well in U.S. dollars, but it's doing well in Canadian, Australian, euros, even the Japanese yen. So, by definition, a bull market is a product that's moving up in terms of anything you want to measure it in. And in the case of gold right now, that's clearly what we're seeing.
Good employment news, especially in Canada. They thought 5,000 new jobs would be created. Instead, it was nearly 30,000. And Canada's unemployment rate, 5.4%, the lowest ever recorded.
And south of the 49th, 75,000 new jobs, and they've been looking for 150 to 175. So just the opposite side of the equation. So what did you end up with on the week? A really strong Canadian dollar. And interestingly enough, in the last couple of weeks, as the crude oil market had been declining, all the way down through the high 50s to the low 50s. Canadian dollar was just holding steadily here at 73.90 to 74 cents for that whole period. And so that's the type of divergence that we like to see around turns in the dollar. When the dollar is either failing to rally with the commodity side or when it's failing to give up ground. And so all we needed was the catalyst on Friday as far as the employment numbers were concerned, both sides of the border, and the Canadian has had a nice big pop here. We would, for all that the trend has been down in the Canadian, these are the type of divergences that can give you a decent rally for a number of weeks. So we look for strength in the Canadian to continue through for a while until we find reason to think bearishly against it once again, which, if anything, probably is leading towards the election this coming fall.
Our good friend Ted Dixon from Inc. Research also pointed out in an interview we did earlier this week that Canada is the free tradiest nation in the developed world in that we have the fewest tariffs and barriers against international trade, which can't be hurting the economy.
Well, as long as others will take our products. If the Chinese would take our products, it would be that much better too, wouldn't it?
Well, we're just letting everybody else know we're open for business, and we're not going to go likely and slap tariffs on you the next minute.
No, we're not going to do it to you unless you've done it to us, and then again, we don't have the same power to come back with.
Of course, on the downside, just think what the Canadian economy would be doing if there weren't so many barriers to energy project development. The latest study showing $500 billion has been left on the table over the last 5 years.
Oh yeah, and the discount once again on the Canadian, Western Canadian Select to U.S. Is starting to grow again, which is not good. But as far as the oil price itself is concerned, we had been thinking that we could get when we were up in the $15 higher than here. We were thinking that it could have a break into a seasonal low the end of May, early part of June. We had some targets that were around 58 to 59. But we didn't have all the ingredients that were necessary to look for at a technical bottom. And we had one of those kick in early in the week on Tuesday. It's a sequential, and a sequential 9, which had been in place on each of the 9th year of a decade in the spring. So that was in 2009, 1999, and 1989. Same type of a sell-off into a seasonal low with this signal. And then an oversold relative strength index, all of that in place by Tuesday. And at the end of the week, we saw the type of reversal that would suggest that we've got our seasonal low in place for the oil market. It may not take off from here on the upside, but I think the bulk of the downside pressure is behind us now.
Ross, thank you so much for chatting with us.
Nice to be back, Jim. My
guest has been Ross Clark from chartsandmarkets.com. Coming up, Hilliard Macbeth, next on This Week in Money.
Always consult your investment professional before making any investment decision.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Hilliard Macbeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. However, today he's speaking to us from Toronto, where you were just the keynote speaker at a conference. What was the conference and what was it all about?
So the conference is a little bit obscure. It's called the Covered Bond, European Council of Covered Bonds. So it's covered bonds are bonds where a financial institution like a bank would sell bonds to the investors, and they give them coverage in the form of assets that are pledged for that bond, like mortgages. So it wouldn't be just a general obligation of the bank where your recourse would be just to all the assets of the bank. It would be specifically a group of mortgages. So you've kind of got a better protection in the sense if something happens to the bank, you could seize those mortgages and they would be yours if you bought those bonds. So apparently they've been around for 250 years in mostly in Europe, but Canada's now getting much more active. So they asked me to speak on my topic, which is the housing bubble and why it has to be a hard landing in Canada. And I was the first speaker in the morning. It was quite, because it wasn't really, I sort of felt like it wasn't the message that people wanted to hear, so I was a little bit nervous. But that's what they wanted. They wanted some controversy. So I went through my thesis about, can it be a soft landing? No. Does it have to be a hard landing? Yes. Will it affect the Canadian financial system? Yes. Will the banks survive? Yes. Will they have trouble? Yes, they'll have trouble. And coincidentally, a paper just came out from the Bank of Canada staff which shows the effect of a severe recession on the Canadian banking system. So I went through that with them as well. And I would say basically, to sum up the reaction, I would say they were very skeptical. Let's put it that way.
Were they much more optimistic than you were?
Well, I think there's this myth that's developed about the Canadian banking system that it's very well capitalized and it's immune to these crises that seem to hit everywhere. Like the U.S. obviously had a crisis 10 years ago, and Spain and Ireland and Sweden and all these countries. Australia's in the middle of just starting to get into a crisis, and of course Canada can have a crisis too. It's just one of those things, especially when you get a housing bubble and associated with a bunch of debt bubble. But the people that are actually living in it, and when it hasn't happened for such a long time, and in Canada it's been 20, 30, 40 years since we've had any major real crisis. We had a minor almost crisis during the 2009 downturn, but it didn't really affect anybody's jobs or anything. So people become very complacent, and that's the word I use, complacency. And so it was a little, I don't know if I succeeded in convincing them that it could happen here, but it can, and it probably will happen here too.
Toronto just announced that they had a 19% increase in sales year to year in May. Is that a believable figure, or were the figures so low before anything would look like an increase?
Well, it's pretty misleading. It's what they call spin, right? So every year, from April to May, the sales go up because it's the spring season of real estate. So the one to look at is year over year from May of 2018 to May of 2019, and I forget if it was up slightly or down slightly, but there wasn't a big change. So no, it's normal for sales to go up in May, and I was just talking to some other people here in the last. I've been here for a couple of days now, and there's been some big declines, like the 20% range in some of the suburbs of Toronto, but the center core of Toronto seems to be holding on fairly well in terms of pricing, but the activity levels are still pretty low. It's not the disaster that Vancouver is turning into yet, but it's kind of like on a pause, and we don't know if it's going to go, resume the uptrend, or whether it's going to go into something more like Vancouver, where prices are down 30, 40, even 50% at the high end.
Well, Toronto might be a bit different, because I just saw an article on the weekend that said it was the fastest growing city in North America.
Yeah, there's a lot of, I was just talking to somebody a few minutes ago, actually, and they said that there's a whole bunch of people applying. Now, I don't know if this is true, but it seemed like a credible person. There's a whole bunch of people they're coming through Toronto to apply at embassies to emigrate to other countries. So, but he said they were fleeing the United States, so they're trying to get away from what's happening in the U.S. So maybe Latin America as well. So the tougher Trump gets with that border between Mexico and the U.S., the more pressure there might be on Canada in terms of taking in some people. But immigration has been a factor in Canada for quite a long time. Toronto's kind of the epicenter of immigration, but it's not a huge number of people. You're talking 1.5% or maybe at the very peak 2% increase in population in Toronto. So they do like to use that argument to say the house prices can't go down. But that would be incorrect because the gains in population in Calgary and Edmonton have been 2.3, 2.4% annually up until recently for a decade, and house prices in Edmonton are lower than they were in 2007, and in Calgary they're lower than they were in 2014. So even with immigration, it doesn't guarantee that house prices go up.
Are bond yields predicting a recession?
There's some really strange things happening in the bond market in the world. I was just looking at it again, and it's just all happened in the last couple of weeks. So the bond yields are coming down, and usually that does mean that people are selecting bonds over stocks, let's put it that way, and also thinking that the central banks around the world are going to cut rates on the short term. So just to back up one step, central banks don't control the long-term bond rate normally. They do control the short-term bond rate. So if people think that the central banks are going to cut the short-term bond rate, then as they call it, the short-term notes like treasury bills, then they want to get their money out of that because they don't want to get hit with a lower yield, and they move their money out to longer-term bonds. And when they start buying all those bonds, they push the yields down. The other reason that people might do that is because they think that a recession, they're kind of related, but if they think a recession is coming, then they know that yields generally will drop, and they want to lock in the highest yield for the longest possible time. So it's not a particularly positive sign that bond yields are dropping so rapidly. It's one of the fastest drops in bond yields that I've ever seen. So it might be a sign that a recession is coming. It's hard to imagine, but it has been 10 years since the last recession. It's not hard to imagine in Canada. I've been thinking for some time we might already, you and I have talked about this in the past weeks. Canada might already be in a recession, but in the U.S., it's a little bit harder to imagine. It would be kind of an abrupt shift because they've had a very strong economy up until recently. But in the world, the OECD leading economic indicators, I was just looking at them this morning, are the lowest they've been. The normal is 100 and they're at 99. And they don't ever go lower than 99 without a recession happening. So they're right on the cusp of a recession for the OECD countries if the leading indicators turn out to be correct.
What would make you think that Canada could be in a recession right now?
Well, that's a very good question. One of the things that I've been watching is the investment in residential real estate. So, housing construction and renovation, which peaked out at 8%, which by the way is 2 full percentage points above the peak in the United States. So the United States peaked out at 6% in 2006, just before the global financial crisis hit there. Went all the way down below 3%, has now recovered back up to about 4%. Canada was around the same as the U.S. in 2006, around 6%, went up to 7%, and then recently went up to 8%, which is a huge. So in other words, it's one of the most important segments of the economy of all the segments, much bigger than oil and gas, for example. People talk about oil and gas all the time, but real estate construction and renovation is much bigger. It's already dipped from 8% down to 7%. So that sounds, well, only 1%. But when you take 1% off such a big number, then it wouldn't take much more in Canada. It would have to be in a recession. And we know in Edmonton and Calgary, Vancouver, that new construction is going to come to a complete halt. In Edmonton and Calgary, there's thousands of new homes that have been completed that have not sold, both condominiums and homes, single-family homes. And in Vancouver, with prices dropping, the builders will quit building very quickly. Sometimes they keep building a little while longer because they've started something and they want to finish it, but they'll have, even if they want to do it, they won't be able to get financing. So the combination of Vancouver, Calgary, and Edmonton is a pretty significant component of the Canadian economy, and that alone could push us into recession. So there's a lot of signs. Certainly the oil and gas situation isn't great either. So Toronto seems to be a bit of an island. I've been here for a while, and they don't see any sign of recessions here. But everywhere else in Canada, you could point to factors that would say we either in a recession or very close.
Also, too, if they stop building new projects, construction's a huge contributor to the economy, so that means lost jobs.
Yes, it's I don't know the numbers for Canada off the top of my head, but for Alberta, the total number of people working in construction at the peak was 275,000. And a few months ago, it had dropped down to 240,000, which isn't really that much of a drop, because in 2005, it was 150,000. So there could easily be another 90,000 jobs lost in construction in Alberta alone. And I would think that would happen all across Canada. So you multiply by 5, you're talking, say, 400 to 500,000 people not in the construction employment anymore. And that alone would be enough to cause a recession. But then you've got all the other factors, like, for some reason, very complicated explanation, which I don't really know it that well, but a lot of the financing of real estate is also fed back into GDP. I'm not sure it should be. I think it should just be counted as an expense. But anyway, they've done it that way. So as a slowdown in new construction, new condo buildings, new houses, all that sort of stuff goes, when the financing stops, then that cuts GDP as well. Then you've got architects, engineers, you've got all of the associated. Then you've got, on top of that, one of the biggest correlations out there is furniture sales. So when people stop moving into new homes and new condos, furniture sales drop. One of the first things to go. And of course, we also know that auto sales have been dropping now for 7 or 8 months in a row. It's quite a significant drop in auto sales. It's not just in Canada, but in the U.S. as well. So whether that's because everybody's waiting because they want to buy the hot new electric car that's coming out soon, or whether they just have run out of the enthusiasm to buy cars, I don't know. But certainly the timing for car purchases is good, because the fleet, people measure how old the fleet is on average, and it's one of the longest time. People have held on to their cars longer than they ever have. I think it's 11 years or something, but there doesn't seem to be any enthusiasm for new cars. So whether it's a financing issue or whether it's a pause because of people are confused about what car they should buy, we don't know. But that it could also indicate a recession.
Yeah, and a lot of people took out 8-9 year car loans. They don't want to take on a new loan until they've paid off the current one.
Will they ever be able to pay a 108-month car loan? It's unbelievable. Like, that's, it wasn't that long ago. The longest loan you could get was 60 months. And even that was not normal. It was 48 months was normal. So a lot of those people, they're paying a car loan off, and the car's worth way less than what the loan is. So they go in to buy a new car, and maybe this is the explanation right here, and it's that simple. And they go in to buy a new car, the guy says, well, we can't do anything unless you give us $10,000 or $20,000. And the guy says, well, I don't have that money. Well, then you can't get a new car then.
We'll have more with Hilliard Macbeth when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Hilliard Macbeth. Hilliard, when housing bubbles burst, how long do they usually take to reach bottom?
So the best recent example we have is the United States. It was about a 35 to 40% decline, and the decline started in 2006, and the bottom was reached in 2010, so it was 4 years. And now, that's on average. I think some places like Las Vegas, Nevada, and Arizona, prices are still, I think they've bottomed, but they're still very, very weak. But the rest of the U.S. has been in a recovery since 2010. So that's 4 years of down, and now we've had, I guess, up to 9 years of recovery. And prices in the U.S. are actually back close to where they were in 2005, 2006, before the big drop. So it was 4 years in that case. I think it depends on what happens if there's in that case there was a very severe recession as well as a drop in house prices. So and usually for sure that'll be the case in Canada if when the housing bubble correction turns into something worse than a correction, it alone would cause a recession, and that would kind of compound and feed off of each other. And but it could be over in 4 years, or it could take longer. And certainly this one will be a big one, so it might take a little longer.
With money laundering being such a big factor in Greater Vancouver housing prices, is the percentage drop in prices likely to be even larger than a normal housing bubble burst?
I think so. I mean, there is no real normal housing bubble burst because we've had so few of them over the years. It's like in Vancouver, you got to go back to the 1980s to find the last bubble that burst, and even then it wasn't a really huge bubble. In Japan, for example, you almost have to go to other countries. It was basically 20 years, and it depends on what the banks do. The mistake they made in Japan was they didn't allow the banks to write off the bad loans. There's a whole bunch of bad loans created in a housing bubble bursting, and instead of allowing the banks to write them off and recapitalizing the banks, they just had the banks just sort of go into neutral. They called them zombie banks. They couldn't make any new loans. They couldn't write off the bad loans from the past, and they were kind of just in neutral for a long time. So it depends on how the government reacts. But if you, on top of that, put the money laundering money being withdrawn because greater scrutiny is being put on the money launderers, I don't think we've ever had it. Well, I'm pretty sure we've never had a housing bubble that burst along with a crackdown on money laundering at the same time. I think money laundering's always been with us, but the recent levels are much, much bigger than anything that's happened before. So this is brand new. We don't know, but it certainly won't be good for the high end. And I think money launderers naturally are attracted to the more expensive homes because instead of having to buy 10 homes, they only have to buy 1 or 2. And so that's the area it's getting hit harder. I just heard about, you and I talked last time about a house that went from $11.2 million down to $5.5 million. But there's another one that's even bigger, $22 million home that sold recently for $9 million. So almost 2/3 of a drop there, or more, I guess more than 60% anyway. So, and I don't know if those are money laundering. It probably could be, I guess. And, but it won't help the local people either initially because they're the ones that bought homes will feel the impact of that as it cascades down through to the more average level. Average for Vancouver used to be 1 million. Now pretty soon it's going to be less than that. But eventually, in a couple of years, affordability hopefully will be restored.
Has money laundering likely propped up the BC economy, and perhaps maybe that's why the previous Liberal government wasn't all that keen to go after it?
I think it has. I mean, there's no question that money coming in is helps the economy. They used to call it hot money. They didn't used to call it money laundering, but they used to call it hot money. And hot money moves around from one jurisdiction to another fairly quickly. And I think the money, well, for one thing, money launderers are different from people that work hard and save up, save $10,000 a year until they have that down payment. And then those people, the people saving the money up, they're very careful. They'd say, "Oh, my budget is $400,000 for a house. Maybe I can go up to $410,000, and that's the highest I can go." And money launderers, they don't care. I mean, actually, the normal haircut on money laundering is 20%. So if you got $4 million to launder, you're willing to give up $800,000 or even $1 million just to get that money laundered. So that means that everybody associated with money laundering can make a lot of money because the money launderers are not watching, how big is your commission on your real estate transaction? How much does a lawyer charge? How much, all those things, the money launderer is not as tight as a normal person would be. So it's got to have a positive impact on the economy, but of course it's only temporary if they crack down on that. And, it seems like they're cracking down on it now. It's, and it'll be interesting to see.
Well, they still haven't added any extra federal officers to go after money laundering. They keep saying they will, but they haven't. And, and the government seems so distracted with other issues, maybe they won't.
Well, when they had David Eby at that conference in Vancouver that I spoke at about in April, and Mark Cohodes was there, they had that discussion, and they were talking about how many does it take, and Mark Cody said, well, 50 people, and David Eby said, well, I don't know if we have a budget for 50 people, but whatever that is.
Well, wouldn't you be seizing a lot of money doing that? Wouldn't that pay for itself?
It might be but all they have to do, I think, I mean, I don't know, this is just conjecture, but it seems to me all they have to do is make a very public, high-profile prosecution of somebody, and that'll scare all the other money. As Napoleon said when they asked him, why did you shoot one of your generals? And he said, pour encourager les autres, which means to send a message to all the other generals, and all you have to do is shoot one. You don't have to shoot all of them, right? So and that would be the same here. All they need to do is make a very high-profile arrest and punishment of a senior money launderer, and people say, "Oh, I don't want to get into that situation. I'm going to go someplace else."
Yeah, I think
I'm fascinated to learn where the someplace else is. If it's in Canada or whether it's outside of Canada, someplace else in Canada, or if it's Canada-wide. It really needs to be Canada-wide, because otherwise you just shift it to Alberta or Toronto or something.
Well, sure. The report here talked about $9 billion or something in BC, and I'm not sure of the exact number, but the number for money laundering was $47 billion across Canada. So it's not just BC. It could be St. John, Newfoundland, or St. John's.
Yeah, and I think the way they got that number is a little bit suspect, because they just basically took the number of transactions that, as I understand it, I could be wrong,
really?
But it was just basically they were looking at transactions that were done through offshore corporations, and there might be some legitimate reason why somebody had an offshore corporation that's not money laundering. It's impossible to tell. But Alberta had a very high level of transactions as well. And population adjustment, actually, Alberta was a bigger number than BC. But I don't know. It's, Alberta might be people buying oil and gas assets rather than real estate, right? So you don't know. There was some big transactions where large Chinese corporations bought a couple of large Alberta oil and gas companies. So that's probably not money laundering, but that would have been caught in the numbers. So those numbers might be a little inflated, but I think as slow as the government is, I think they'll eventually they'll track some of this down, and a couple of one or two high profile prosecutions, and problem solved. Now what the follow it? The question is more about what will the follow be, and it could be quite large, but it'll be all mixed up with a housing crash, so we won't be able to distinguish which part was the crash and which part was the end of money laundering. It'll be impossible to distinguish.
Sure. Well, some people are concerned that combating money laundering will hurt the BC economy, and could this be the canary in the coal mine for the BC economy?
Well, the BC economy was in trouble anyway because of unbelievable. We were talking just a minute ago about the size of the real estate industry compared to the total. Well, BC has to be, Alberta's got oil and gas, and Toronto's got the financial district and all that, but BC, the percentage of the real estate industry has got to be the biggest in Canada. It's there's tourism. Well, this isn't fair. There's obviously other components to the BC economy, but I saw announcements again yesterday of lumber plants being shut down, Canfor, and more, it's becoming a one-trick pony, and so it's going to be difficult. And the thing is that it was inevitable. It wouldn't have mattered whether the Liberal government cracked down on money laundering, or whether the NDP government cracked down on money laundering, or if the federal government changed the guidelines for the stress test for qualifying for mortgages. It was going to happen one way or another. It's just, and then when they write the history books, they'll say, well, I suspect they'll say it was because of the money laundering, but it could have been any one of the factors could have triggered it.
We'll have more with Hilliard Macbeth when This Week in Money returns.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Hilliard Macbeth. Hilliard, are governments in Canada likely to have success in reversing the already bursting housing bubble?
I don't think they will. There's a lot of pressure in Australia. They just had an election in Australia, and of course in Canada we're going to have an election soon in 2 or 3 months. The new government coming in immediately decided to try and reverse some of the things that the previous government did to try and short-circuit the housing correction that's already started in Australia. In some cities, the prices are down 30-40%. In the big cities like Sydney and Melbourne, they're down about 10%. So we're kind of seeing we're seeing the future a couple of months ahead of time in Australia's situation that was coming to Canada with it after our election. So I don't think the current government going into the election in, I guess it's October, is probably going to make any big changes. They made one minor change with the rules for first-time home buyers, but it's pretty minor. It would require something major, and I don't see them doing that. Now, if the new government is a different party, as seems likely, then they'll probably make some changes, but I don't think it's going to make a huge amount of difference. I mean, interest rates, if people are trying to qualify for mortgages at 3-4%, and I guess you could get it down into the 2 range, but it's probably not going to be enough to get enough people to qualify. And the first-time buyers are an important component of the whole thing, but they're not the biggest. So the other people that need to sell because they're underwater on their mortgage or because they're older and they want to move to a nursing home or something, those people, it doesn't matter what the government does. Unless the government actually went as far as to actually buy those homes from the people. But I can't see the government doing that.
Well, in BC, we have an NDP government that's done everything to discourage buying a home. A 20% foreign buyer tax, a huge speculation tax if you own a second home, so-called education tax if your house is worth $3 million or more. So they've done their very best to drive down prices, and I don't think they have put any consideration into the lost wealth that went along with that.
Yeah, it's interesting. There's winners and losers. Like the first-time buyers and the people that haven't bought yet are cheering if house prices come down, and then everybody else is really upset. So it's kind of like it's dividing a society. And of course, most people own homes, so it's probably more likely that there's more people upset than there are people that are cheering. And then, of course, most of the people that own homes are older, and they're more likely to vote. So there's really no government that really wants to see housing prices go down. I haven't had time to look at it, but I'm guessing no government has ever been very successful at the next election if housing prices are declining.
Well, so and I would think too in BC with an older population, a lot of people were looking forward to selling their home and having a huge bank account to fund their retirement.
That's a theory, but and I'm coming to the end of my 41st year of doing my financial advisory job, my main job. And boy, it's amazing how few people actually are able to do that, and Alberta had a pretty good, basically prices tripled in the last 15 years in Alberta. It quadrupled in Vancouver, but tripled in Edmonton and Calgary. And you'd think some people would be able to take money out and have a fat nest egg for retirement. But, first of all, people are reluctant to sell because they, if you just sell and then buy something else, you generally don't take money out. The other way to do it would be, say, if you're in Vancouver, to sell and move to Kamloops, for example. I'm assuming there would be a big price differential there. Nobody wants to do that. Nobody wants to leave Vancouver to go to Kamloops. So it's tougher than it sounds. Like, it makes a lot of sense. I have counseled some people to say, why don't you sell and then rent? And then you can stay in the same neighborhood. You could stay almost on the same street if you dig around. I even talked to some people that sold their home and then to an investor, and they said, "Then we want to stay here. We want to rent from you." And the investor agreed to that, so they don't even have to move. But you do give up some control. So, yeah, and as the housing crushing gains momentum, it's going to be tougher and tougher to sell, especially if you have a more expensive home. If you're in the $3 or $4 million category, there's a lot of them for sale, and there's not very many buyers, so it gets tougher and tougher as time goes by. So most people, if they're older and they can afford to stay in their home, they'll end up just saying, "Oh, you know what? We'll just stay here."
Could lowering lending rates lead to a booming economy in Canada?
It hasn't worked elsewhere. So I mentioned Japan a minute ago. In Japan, the peak was in 1990, and 25 years of declining house prices, declining land prices in Japan, and a relatively poor economy all along the way. And interest rates were zero for most of that time. There was no, money was almost free. So I mentioned a minute ago the zombie banks. So the cost of money is not the most important factor. The most important factor is availability of money and the desire to borrow. So you need two things. You need the banks that are able to lend, because they're not saddled with a bunch of bad loans. And you need a borrower that is qualified to borrow and also is willing to borrow. And a lot of times when prices are falling, even cutting the interest rates wouldn't be enough, because the borrower is saying, "Oh, I think I'll just wait. Yeah, I can get a loan for 1 or 2%, but if I buy the asset that's worth $1 million, and 3 years from now it's going to be worth $800,000 or $700,000, the 1% isn't going to help me. I've lost $200,000 or $300,000. So no, that by itself, cutting interest rates is not going to do anything or much, really.
Well, we're hearing right now that banks are reluctant to loan money, so it's harder to get a mortgage. So even if the rate is lower, it's harder to get.
I tested that recently. I don't know if we talked about this, but I was in a bank branch 3 years ago, and then just recently in April I was in the same bank branch and I asked the same question. And 3 years ago, the answer was $1 million, no problem, in terms of what could be borrowed. And in April this year, it was, "Oh no, we couldn't do that." And it was a senior lender, senior bank, and it wasn't just the stress test; it was just an attitude in the bank that they were going to be much more cautious. Now, maybe that was Vancouver, because the bank's aware that Vancouver prices are dropping, but I didn't get that impression. I got the impression it was more of a shift that would be more Canada-wide. So just a general sense of more caution from the lenders, and that's all it takes. You get the borrowers kind of hesitating, and you get the lenders tightening up quite a bit, and the next thing you know, you've got a real slowdown, and that's what's happened in past cycles, and that's what's very likely to happen in this cycle as well.
Is China's economy in trouble?
I don't know. China is. Certainly the signs are there that things are slowing down, but it was growing at a rate that was unsustainable anyway. So there's a great book, it's kind of hard to get your hands on, but it's called The Princess of the Yen, and it's by Richard Werner, and it's about his time in Japan when he was an economist working for a major investment house, but he was advising the Bank of Japan. And he talked in the book about how the central bank ordered banks to make loans, and they didn't order them who to make the loans to. They just ordered them, "You're going to give these loans and that." And to me, the country that's in that same position, this was going back in the 1970s and 1980s in Japan. Japan built up this amazing economy over 20, 30 years after the Second World War. And it was partly done through directing bank credit to certain borrowers. Not to build condos and houses like we have in Canada, but to build, car manufacturing plants and all kinds of other stuff, productive stuff. And China's in that mode now. So China has the ability to turn on the taps in in a stimulus way that a lot of other countries don't have. So while the economy is slowing down, they could be heading for a crisis. It's one of the countries that's been identified, like Canada and Australia, as being overdue for a crisis, a financial crisis. But China has that unique capability that Canada and Australia does not have, which is the government can direct the loans. For instance, they built a new airport for Beijing. The current Beijing airport was completely at capacity. So 5 years ago, they decided to build a brand new airport with 7 runways, and I forget the numbers. Anyway, it's like, think of the Vancouver airport and then multiply it by 20 or 30 times. A high-speed train link, a subway link, and all of that is going to open in September. 2 months, 3 months from now, it's going to be open and ready to go. So, I mean, that's the kind of thing that China can do that we can't do. Australia can't do. Very few, can't do it in Europe. So yeah, they're going through a slowdown, but whether the bubble would burst, I'm not as confident to predict the China bubble will burst, because they have the ability to turn it around but it's really the spending. It's not just cutting interest rates, it's actually directing the spending. And, they can build whole cities faster than a project in Vancouver could get approval, much less be built.
Could failing Canada-China relations have an effect on the BC housing market?
Oh, for sure. And, it's a global thing. This global trade war is, and I think global, it's fair to say it's global now, is really impacting a lot of different things. So once that trust is gone, people start to second guess, small businesses, $500,000, $1 million could be enough to cradle them. So if they think about they're going to sell to China or import from China, and they worry that the government might slap a restriction on it, that could be the end of their business. So they get very, very, very careful. And, think about people traveling from China to Canada, or traveling from Canada to China to do real estate transactions or other things. You start to wonder, people are getting arrested, and what if they retaliate and arrest people over there? I don't suppose they'd arrest people randomly, but all of these thoughts start going through people's minds, and then trade slows down, and then business slows down, and then one of the countries that I was surprised to learn that Germany and China have quite a close trading relationship, and they've been visiting, the Chancellor of Germany has been visiting China 2 or 3 times. I think it was once a year or twice a year for 10 years now, and trying to work on that sort of thing. So we'll see whether it's just Canada and the United States or whether it's global, but for sure it'll impact us. There's no question.
Are foreign housing buyers from mainland China likely to sell real estate in BC and repatriate their money back to China?
I don't know the answer to that. My guess would be no. I think once they got the money out, assuming that they may have broken some of the rules when they were getting the money out, the last thing they would want to do is take it back, because I think they're more likely to just want to keep it secret that they actually took the money out in the first place. And
almost like money laundering.
Yeah, bringing the money back would just risk the Chinese authorities finding out about it, right? So if they successfully got it out, I think they probably would. No, I think of what's more likely to happen is they might sell properties in Vancouver if they can, and just keep the money in Canada in Canadian or US dollars. But bringing it back to China, I don't think that's likely to happen. A lot of them have sent their children over here to be educated, and they've gone to a lot of trouble to try and sort of have an escape route, if you like, or just to start a new life in a new country. And so reversing that doesn't seem likely. But in terms of reversals, there are some reversals. I understand the Chinese government is putting a really big push on artificial intelligence, and everybody that works in the high-tech software artificial intelligence area is being offered really good jobs to move back to China, and a lot of them are taking the jobs, whether they feel like they don't have any choice or not, I don't know, but one contact I have in that industry tells me that that's what's been going on now for more than a year now. So China's determined to, for instance, electric cars. They are putting such a big push on electric cars. It's way beyond anything that is happening elsewhere. Tesla's doing something in the U.S., but it's just Tesla, and there's a little bit going on in Europe with Volkswagen and other and Volvo, and that. First of all, was owned by a Chinese company called Geely, but in China it's just all out electric, and they're really pushing hard. So it'll be interesting to see if they're talking 24 million new cars a year in China. The U.S. and Canada combined is less than 20 million. So there will be a lot of opportunities in China that probably won't appear in Canada and the United States to get involved in things like electric cars. So yeah, I guess people, it might have a certain dynamic feel to it that might attract some people.
Hilliard, where can people find copies of your book, When the Bubble Burst: Surviving the Canadian Real Estate Crash?
So it can be ordered from Amazon online. It can be bought in any of the major bookstores in Canada. I just looked at a bookstore in Toronto yesterday, and they've got a copy there. So it's still available. It's now been 4 years, I guess, and it's first edition and then second edition. The only thing I would say is, when you go on Amazon, make sure you get the second edition. There's a link there that has multiple editions, and for sure you want to get the second edition, which has the red cover. So, but I encourage people to do that, because watching the bubble bursting right now is highly. I don't want to use the word entertaining.
Interesting.
Interesting. And to have the background of the explanation that I provide in the book would make it even more interesting.
Hilliard, thank you so much for being on This Week in Money.
Nice to be on the show. My
guest has been Hilliard Macbeth, author of the second edition of the book, When the Bubble Burst: Surviving the Canadian Real Estate Crash. His website, macbethgroup.com. Coming up, Wolf Richter, next on This Week in Money.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. I'm speaking with Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to This Week in Money, Wolf.
Thanks, Jim, for having me back.
Wolf, after some really bumpy downs, the Dow seems to have recovered. Could we see 50,000 points on the Dow?
Well, I'm pretty sure that someday we will see it, simply because the Dow is an average of dollar-denominated stocks, and the dollar is losing purchasing power constantly, and at a rate of 25 to 30%, sometimes 20% per decade. And so, it doesn't take too much math to figure out, even if nothing else changes, at what point we would see 50,000, and that means that the purchasing power of the dollar has declined to the point where now it takes $50,000 to buy what would have been $25,000 some time ago. So from that point of view, we will see it. So it'll take a while. It'll take a few decades. And in terms of overall market performance, stocks are incredibly overvalued right now. And after the longest bull market in history, and after QE and record low interest rates, and a flood of global liquidity, the amount of overvaluation out there is pretty high. And in first quarter already, earnings were flat to down, corporate earnings. So it's not like we have a booming corporate sector. The economy in the United States is slowing. It's still growing, but slowing globally. It might be in worse shape than in the United States. And the Dow companies are global companies, so they do business all over the world. And if something happens in China and in Europe, it's going to impact them. So I don't see a lot of reason to believe that the Dow will hit 50,000 anytime soon. But just giving the purchasing power issue with the dollar, we know it will eventually get there. We just have to be patient enough. Of course, by that time, the dollar will buy a heck of a lot less than it does today. And the gains that we made are really just fake gains. And, when you think of doubling, the Dow would have to double to get there. And, after having already more than doubled in 10 years, So I think it's very unlikely that that we will see in the next 10 years. I think we will be looking much further out. And, and I think we will see a big dip before we even get back to the peak levels where we were late last year, or August last year. So it's going to be rough for the Dow for the next few years, I think.
Is that also an effect of the tariff wars on between the U.S. and China right now?
Yeah, so the tariffs are an interesting issue because it goes both ways. And there are a lot of companies that could get hurt pretty badly, and especially companies that do a lot of business in China. That could be targeted in China. In terms of importing from China, tariffs are just a tax, and on companies, on corporations, and they got a huge income tax cut in 2017 and in 2018, and so now they're going to get a little tax on imports. So it's not a huge factor. I don't think it will squeeze the margins a little bit, and that's okay because the income tax cut helped them a lot and that boost stocks. So it's that part which is sort of diminish a little bit of the boost that they got last year. So I don't think that's a big issue in terms of in terms of trade and the economy in the United States. I think it's a much bigger issue in China, and I think the United States has such a huge trade deficit with China, gigantic trade deficit, that for us here, that is a problem. And reducing that deficit is going to be painful for the countries that have a surplus with the United States. So, especially China, this is going to hurt, and supply chains are going to get rerouted, and it's going to benefit maybe Vietnam and some other Asian countries, and it's going to hurt China some. I mean, there's going to be some shifts in that's for sure.
China is talking about withholding rare earths from the U.S., and they're the biggest supplier in the world. Could that hurt the U.S. economy and also the U.S. military?
Yeah, the rare earths are actually not rare. They're everywhere, and we have one mine in the United States. We just don't process it here. It's really messy. It's really dirty to process. The toxic materials that need to be used. And so all that work has shifted to China, because in the United States it's too hard to do. But it's not that hard to start that industry or restart that industry in the United States. If prices are high enough, that will happen. That it just needs when prices rise, prices solve a lot of issues. If prices rise enough, there will be a lot of initiatives in that respect in the United States. So, rare earths are used in everything, and they're everywhere in the entire world. It's just mining them and processing them. It's a very filthy thing. And we mine some in the United States. So there's a big mine here, but we don't process it here. So it would require some shift there.
We'll have more with Wolf Richter when This Week in Money returns.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Wolf Richter. Wolf, what's the latest on interest rates and the availability of credit?
Long-term rates in the United States have collapsed. The short-term rates are kind of where they were over the last 8 months, but since the last rate hike in December. But the long-term rates, the 10-year Treasury yield, for example, has come down by a 4 percentage point. And so that has lowered mortgage rates. Mortgage rates are the 30-year fixed-rate mortgage, which is the standard mortgage rate that we have in the United States. It has come down by about 1 percentage point since November. So it's now just above 4%. It was just above 5%. So the rates have come down on the long end in terms of savings. So interest rates that savers get, they have come up a little bit over the last year or two. And so people are making a little bit more money. The problem we now have is that the long-term rates or long-term yields are below the short-term yields. So a 10-year Treasury yield today is 2.12%. And that compares to the 3-month yield of 2.35%. So we have an inverted yield curve where long-term rates are lower than short-term rates. There's a big sag in the middle, so the 3-year yield is particularly low. It dropped to 1.8% today. And that causes all kinds of concerns in the markets because it sort of predicts a recession. I'm not sure that's the case this time around, but that's been the case in the past. In terms of credit availability, it's as easy as it's been. In terms of corporate credit, it's as loosey-goosey as it can be. The worst, highest risk junk-rated credit, people are going after them. They're chasing yield. Investors have become reckless again. This is tracked in various indices, such as by entities like the St. Louis Fed, and it has a financial stress index, for example, which indicates how much financial stress there is in the system, and there's none. I mean, financial stress in the system is near record lows. So credit availability in the corporate sector is very loose. It's very easy to get credit. The riskiest junk-rated companies can refinance the debts no problem at relatively low rates. On the consumer side, credit is still very easy as well, except on the subprime portion of it, and it's particularly in the auto credit. So the auto loan section, they have taken big losses over the past couple of years because they got very aggressive. The specialized auto lenders got very aggressive in 2014, 2015, and those loans have defaulted at very large numbers. So now lenders have tightened up. Some of the specialized lenders have collapsed, the lower ones. And so on the subprime side for auto loans, it has gotten tighter. And this has moved some of the buyers out of the new vehicle market. So these are subprime rated, customers with subprime rated credit, they can no longer buy a new vehicle, and they get switched to used vehicles where it's a little lower risk for lenders that have lower loan values and lower prices, low risk, and so it's a little easier to deal with there. They're still buying cars, they're just now buying used cars more than new cars. And so our new car sales have dropped because of that, slightly, not a huge amount, but they're down 2 or 3%. And again this year, and it's going to be the third down year in a row, in part because of the tightening up of the subprime credit. But that's about the only corner of credit getting significantly tighter. The rest of it, with long-term rates coming down, it's very easy to get credit all around, and consumers as well as companies and governments too, are taking advantage of it. And so there's all kinds of borrowing going on, and the credit field, momentum is still there.
We'll have more with Wolf Richter when This Week in Money returns.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Wolf Richter. Wolf, how is consumer spending in the U.S. holding up?
And everybody's watching consumer spending now because the worry is a recession, but the consumer is really the dominant economic player in the U.S. economy, and consumer spending is doing good. It's holding up. It's right in the middle of the range of the past 6 years. I mean, last year they had a phase for a few months where it was red hot. It's come down some from there, but it's now in the middle of the range, growing at around 2.5, 2.8% a year on an inflation-adjusted basis, which is pretty good. Personal income is in the same ballpark, in the middle of the range, not red hot, but good. Disposable income is in the same range, and people are saving money. The savings rate is 6%. So the consumer is doing good. And when we talk about the consumer, it's an economic entity. It's an economic figure. They're not really, it's not really a person. So, when we look at individuals, it takes a very different, magnitude, because you have a very, disadvantaged part of society. And, the homeless population is growing in leaps and bounds. We see that in the Bay Area, one of the wealthiest, most expensive parts of the country. And our homeless population surges. The same in Southern California and other parts of the country. We have the poorer parts of the economy that are facing these rising costs that we're seeing in housing and in other expensive items, and so they're very disadvantaged in this economy. And then on the other hand, we have a fairly significant part of the population that is doing very well. And these are people with good jobs, and there's lots of good jobs in the service sector. And that service sector includes healthcare and finance and telecommunications and data processing and this whole thing. And architects, lawyers, that's the biggest part of the economy, and jobs in that sector are good, and companies are still hiring. Those people do well. People with assets in general are doing really well because asset prices have been inflated by central bank policies from housing through stocks and bonds. So, there's a very large layer, of the population that's been pretty good. And within that group, there's the regular workers, and they're the top 10 or 15%, that are doing exceedingly well, and they're spending a lot of money. So consumer spending overall is doing pretty good. And at these current levels, we're far from being able to dip into a recession. Consumer spending would have to drop significantly before that could happen. And if you get into a huge wave of a tsunami of layoffs, that would change. That would change consumer spending in the New York minute. But we're far from that, So at this point, consumer spending is propping up the economy, and it doesn't look like it's dramatically changing in any particular direction.
Global semiconductor sales have been on the news, and not in a good way. What's going on there?
Yeah, and that's everybody's pointing at China. Global semiconductor sales peaked in the fall last year, and they have since plunged nearly 25%. And that's a very large drop. In terms of the dollar drop, it's the biggest dollar drop from peak to trough, in the history of the data that we have. In terms of the percentage drop, the 25% drop is large, but during the financial crisis, it was a 39% drop, and during the dot-com bust, in 2000 and on, peak to drop, it was like a 45% drop. So the 25% drop right now is pretty significant, but it doesn't stack up with these crisis drops. Now, what has happened is that to front run these tariffs and potential export restrictions from the United States, companies in China have stockpiled inventories of semiconductors, and that started last year, and Huawei is one of them. And there's been reports out now that they stockpiled up to a year's worth of inventory in the most critical components they need. And, Huawei is the second largest smartphone maker in the world, and is a very large telecom equipment maker, and is leading on the G5 front. So they have seen this coming, and they have stockpiled, and not just Huawei, but all kinds of other companies. And so we saw sales surge last year, and earlier last year, starting in late 2017, and now we know why, because we're getting these reports of the stockpiling going on to front run the tariffs and export restrictions. Then in addition, we have things that are not really related to the trade issue. Smartphone sales are now mature, and they stagnated in 2018. There's global smartphone sales. And in the first quarter of 2019, they actually declined. And it's not just Apple. I mean, Apple iPhone sales are way down. Apple is really having a company unique problem in that its devices are too expensive. It has trouble competing. But it's global sales among all manufacturers, and so they're now declining. Then PC and laptop sales are declining in the first quarter again. And that's been problematic for a long time. That business has been mature for a very long time. And that's in the first quarter, they're down nearly 5%. That adds to the decline of about 3% of smartphone sales. Last year, the crypto mining business collapsed. So this is when cryptocurrencies get mined with via large computer systems, and as the cryptocurrency prices collapsed last year, the mining fell apart. And so these companies that do that stopped buying the equipment, and they're specialized chip manufacturers that made these special mining chips. And so those sales collapsed last year and have not recovered since then. And now, in addition, we get reports that the data center boom that's been going on for many, many years is starting to slow down. And Intel has reported that 2 quarters in a row now and it's pointing at China. And so these are factors that are now all coming together. They're all chip-intensive industries, and it doesn't take much of these confluences to cause that kind of plunge between the data centers and the crypto mining collapse, the PC and the laptop declines, the smartphone declines, and all the issues in China. Suddenly we're down by 25% in semiconductor sales. And there is hope that this will change next year. So right now the industry is forecasting a significant decline for all of 2019. So maybe the decline will sort of slow down towards the end of the year, and they hope for a mild increase from those much lower 2019 levels next year. So when you look at the semiconductor stocks, many of them have gotten crushed down 30, 40, some of them 50%. Because of this issue, depending on how involved they were. Some of them have come out okay, and the revenues are down across the board among these companies. So this has been going on, and it's a big issue with pretty serious consequences for these companies. Now, so far, everybody's optimistic that this will blow over, and by next year, and we'll have to see. The China issue is something that nobody knows how that will turn out. I mean, in terms of U.S. suppliers, it could be more long term, and if China finds other suppliers or is able to develop its own chips to replace U.S. chips, then this would have some long-term consequences.
What about the development of AI and the East versus West? We're hearing that traditionally Chinese students that came to Canada to study usually stay here, but now they're being lured back to China to develop AI. Is the same thing happening in the U.S.? Are they, A, trying to retain people for AI, and B, are they losing people to countries like China who are really working hard to become the world leader in it?
Yeah, I mean, everybody's trying to hire AI experts right now, and whether they're still in school or they've been out, and this is a fairly new industry on that scale, and they're getting paid lots of money, and so this is a very competitive market, and whether it's companies in China or companies in Silicon Valley or wherever, or in Canada, they're going to have to offer competitive salaries and incentives to get these people that they think can help move this forward. Now, AI has not proven to be, AI is everywhere already. Everything we do is already, to some extent, controlled by AI, whether it's, it's just everywhere. Every little thing, it has now some factor of it. But the complicated, large-scale applications of AI, like self-driving cars and those kinds of things, when they're still handicapped by the difficulties that they're facing in reality. So, there's a lot of development work left to do, and it's not progressing maybe as fast as people would like, and so everybody's trying to become the leader in it, and it's very tough. It makes sense for China to try to attract people, not only Chinese people, but Western people from anywhere. It doesn't really matter where they're from. Just get the best brains to go there, and at the same time, other countries are trying to do the same thing. So it's a very competitive market right now.
Wolf, how can people find out more about Wolf Street?
Everything I do is on wolfstreet.com. It's my website. It's free. It's just business, economics, and finance. I stay out of politics.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He spoke to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Hilliard Macbeth, Wolf Richter, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, Jim, I'm glad I made it to talk to you because I just left downtown where we had a couple of meetings, so I just walked in the door when you phoned.
Larry, all this busyness, what's kept you so busy?
Well, it's an interesting time, and I think the dynamics have changed. We've always had a lot of meetings in a month, and usually at Cometco because we'd go through the process and everything else and explain it. But most of that was tire kicking, and but it seems now that there's a lot more urgency, with our meetings, and we're meeting with some substantial companies. And, something will come out of it, I'm pretty sure, but I can't say when, but some of them are very anxious, and but it's got to be the right deal. It's got to be the right deal for them. It's got to be the right deal for us. And but anyway, it's very interesting times. I mean, it's exciting. You can feel the excitement in the room when you're having a meeting, and some of these meetings, which we're scheduled for an hour and a half, end up being 3 hours. So that's always a good sign. So that's what we've been up to, and I gave another kind of a podcast yesterday on a video stream, and with Proactive, and so I talked about a lot of things that was sent out to our listeners. So I don't want to repeat myself, but it's I guess the most exciting thing that's happening is we're kind of run off our feet here. There's Zarko and myself that attend these meetings, and because we've got to at least be two on our side of the table, and for reasons of if I'm stuck, Zarko fills in. If Zarko's stuck, I fill in, and there's a lot of questions that go back and forth. There's a lot more to do with what we're looking for when we try to find out what they're looking for. And, we just leave with always shaking hands and, promising to keep in contact, or they'll get back to us in a week. And it's an exciting time. I mean, we've got a lot of interest in what we're doing. And it's not that we haven't. We've been having meetings here for over 2 years. But like I say, the tenure has changed. The caliber has changed. The requests have changed. I just feel charged up about the whole thing, and I think it's going to be great for the company. Just God knows when. It could be as early as a couple of weeks. It could be as long as 2 or 3 months. But I just have a feeling that something's going to happen here very quickly. And there's a reason for it. Of course, the rare earth scare in the U.S. Really tells you that you don't only have rare earths in peril, you have all of your strategic metals in peril of not being able to import in the U.S., so there's big interest there. We're even getting, setting up conference calls with some of the states, or at least one of the states. And, they're talking about setting up recycling rules, et cetera, and so this is great. This is a great time.
Well, Larry, I know some of the articles about concerns about electric vehicles is recycling the batteries. You have the solution.
Well, we certainly have the solution for, handling the batteries when they reach the end of life. And it's a cradle-to-grave solution. We'll probably see dozens of plants after a few years. There will be all over the world, and that's where we're getting the interest too, is from all over the world. And not only that, but the interest in the U.S. has stepped up significantly. So the only ones that we don't hear a lot from are Canadians, and of course we're always a day late and a nickel short when it comes to things like that.
Larry, for people new to American Manganese, what do you do, and why are your plans for battery recycling so exciting?
Well, American Manganese is a critical metals company. We've got certainly have a big handle on one of the largest deposits in Arizona, and that is indirectly is why we're in the recycling area, the urban mining area, and that is because we developed a method of taking very low grades of manganese, and people should keep that in the back of their mind because the U.S. is going to require that at some point. And we can get those low grades at the same cost as Chinese grades, which are anywhere from 15 to 20 times higher. So, we're in that field, and we've taken that patented process, and we've adapted it to our recycling. So that's why we ended up with 2 patents now in the recycling area in the U.S. We've applied in 7 other areas. So we're the owner of 6 patents total. And, that's someday they will evaluate the company by the amount of patents that it holds. And we certainly should be evaluated much higher than we are. So, it's been a tremendous run here for the last 3 years. And I expect that that's only going to get more intense here going forward. So, but where are we traded? We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF, and we're traded on Frankfurt under the symbol 2AM. You can find out anything you want about the company and our process at AmericanManganeseInc.com. You can phone the company here at 778-574-4444, or you can send me an email at LREAUGH@AMYMN.com.
Larry, thanks a lot for the update.
You're very welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on June 7th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.